Hello everybody, I'm Jeppe Kirk Bonde, one of the most copied investors on eToro, and welcome to this 2026 Q1 quarterly investor update. If you want to use this presentation for anything, please go ahead and read the disclaimer here at the bottom very carefully. So in this presentation, I'm going to go through my background, my investment strategy, what I have in the portfolio, and then through the many questions that I've received. So firstly, one of the reasons that more than 25,000 people are copying my investments on eToro is that since I started in 2013, I really outperformed all of the relevant benchmarks and also had a higher average return and better return to risk than most of the top investors you could fairly compare with. It's a very fair comparison, for instance, against Terry Smith. He started Fundsmith in 2014. I started in 2013. So we've been sort of investing for the same period, but I think with a quite significantly better performance from me. You can't really fairly compare with Warren Buffett. He's obviously done well for so many decades that that'll only be sort of maybe at the very end of my career. You can look career for career. My background, my dad, he was a member of the European Parliament for 29 years and the leader of a political party. And so growing up, I thought I would be a politician as well. But then during university, I started studying political science and decided to switch for my master's to finance. And then I started work as a management consultant, advising some of the largest companies in the world, including tech companies, aerospace and defense, and especially banks. And then as I was doing that, I was making more money than I was spending. And so I wanted to invest my money. And I was quite unimpressed with what my bank was offering, what my pension fund were offering. They were really charging high fees to not provide very well diversified portfolios. Then I compared all the different platforms and scored them on different factors. How good are their prices? How good is the availability of instruments and products on their websites or apps? How good is the app? How good is the website? How is the security of the platform? How is it developing over time? And then based off of how well they scored those factors and how important those factors were to me, I multiplied them up, ranked them all, and ahead came eToro as number one. Then I started investing on eToro. And then as my investments did quite well, more and more people started copying me. And in 2018, I decided to quit management consulting and focus only on managing my money on eToro. And I hired some people to help me. And 1 year later, I was then the most copied investor on eToro. And today I'm the second most copied on eToro with 26,000 people that copy my investments for 210 million US dollars and with 600,000 followers on eToro. I don't do everything on my own. I rely on some great suppliers to provide data and give me access to the right tools. Then I have a good network of experts that I trust. So if I invest in something, I either have to myself be an expert in it or know someone who is. Otherwise, I can't get to the most important insights quickly enough. Then I have two great assistants that help me. And finally, I'll highlight my favorite experts, which are my three brothers. One of them, he did his degree in computer science, focusing on AI, and works now with AI regulation, traveling a lot between London and Washington, D.C. The other one, he is an economist in the Danish Ministry of Finance, and he's built Denmark's largest economics models. And the final one, he's a CEO of a large marketing company. So if any questions or concerns in those areas, then I'll just reach out to my brothers and get some help. My investment strategy is based on some principles that have been there all along. I focus on capital markets and what kind of growth rates different pockets of the capital markets can have in different places. I focus on megatrends, the important factors that can really change the world over the long term. Then I focus on fundamentals, really analyzing companies carefully to understand their products and services. What is it like to be an employee in that company? What's it like to be their customer? What are their management teams like? What kind of technological capabilities do they have? What are their suppliers like? What about their suppliers? What could this company do in different potential future scenarios? And how are the financial statements? How have they been over time? How could they be in the future in different scenarios? All of that with an eye on evaluating what I think this company should truly be worth. And then I want to invest in companies that I evaluate are worth a lot more than their price would indicate. And there's a great quote by Warren Buffett who said that price is what you pay, value is what you get. And I really subscribe to that view. Then I focus on the long term, which is sometimes difficult for people to understand because there's always something going on right now that you feel like you should react to. And of course, if you're always right in the short term, then the long term should take care of itself. But if you want to manage your own life or your portfolio or a business well, you're really better off if you focus on the things that are important long term and sort of to an extent ignore the noise. After a long time, you will simply find yourself much better off and realize the people that focused a lot in the short term, they certainly did a lot worse in the long term, but they didn't do any better in the short term either. There's a great quote by Benjamin Graham. He was sort of the mentor of Warren Buffett and the author of a famous book called The Intelligent Investor. And he said that in the short term, the market is a voting machine. In the long term, a weighing machine. It essentially means that in the short term, it can be important what people think, other people think. But in the long term, if a company actually does the right things and become big and profitable, it'll be very nice to own a big part of such a company. And I have the patience to ignore the voting and wait around for the weighing. Then I focus on risk management, carefully diversifying across different geographies, industries, and business models. I do a lot of hedging, so that means investing in different assets that, maybe they are each risky, but when taken together, they are actually less risky. A great example of that is if you, for instance, have a lot of companies, as I do, that need a lot of energy, but then you also have companies that produce a lot of energy. Then, to some extent, you can now ignore the energy price, because if the energy price goes up a lot, well, you will have some happy companies and some unhappy ones. But if it goes down, you also have some happy ones and some unhappy ones. So you've now sort of neutralized the effect on your portfolio from the energy price. And always finding ways you can do that is a way to sort of reduce the risk in one's portfolio without sacrificing too much average high return in each scenario or across scenarios. Then finally, I stress test my portfolio, evaluating how it and variants of it could perform in different scenarios. I've gone through a vast quantity of science fiction to write down all of the different ideas anybody ever had, look through all of history for everything that's ever happened, and then try to just come up with so many different scenarios for what if these things happen together? What if these things happen together? And so hopefully, one day when something happens and everybody goes, oh, nobody could have expected, that would happen. And they're like, well, at least I had, crafted some scenarios along those lines. And that really, every time something major happens, I probably already have thought a little bit about how that will play out. Then I focus on keeping fees low. I pay the same fees as copyists. So if I keep my fees low, copyists keep their fees low. And that includes not using leverage, not shorting, and not doing any excessive trading. So, ultimately, if you are buying and selling everything you have every day, you will be paying a lot of fees, and that will probably lead to a lower realized return. So you have to do some trading, to have the right things you want to have, but it has to be assessed against the fees you pay every time you change something. So then there are some areas where I see great opportunities. I really like companies that have organic growth. That means companies that can sell more products or increase the price of their products by more than the prevailing inflation rates. But it does not include companies that are just growing through acquisitions. Sometimes you can read at the beginning of the annual report that, oh, we grew our revenue by 2% this year. But that's only because you acquired another company. Your core business actually shrank by 4%. So what you've achieved is really not very impressive. Now, there are other companies that are consistently able to acquire companies at a good price and then grow those acquisitions a lot afterwards through synergies or just through good management. And that growth that they get after the acquisition, that counts as organic, and I do like that. Then I like companies that are resilient, that have sustainable competitive advantages, or at least have a clear sort of path for how they can get them. Companies that have a strong balance sheet and can do well in many different scenarios, not just in a few good ones. And ideally companies that can protect me against some tail risks, those things that, are unlikely to happen, but if they happen, they could have a big impact. I like to have, a few companies that, if this scenario pans out in that way, then, this company will do very well and protect my portfolio to an extent. Then I like companies that are profitable, that says a lot about how, they have already achieved something quite incredible, and especially companies that are able to reinvest their profits into their own business to grow them faster over time. My portfolio on eToro is predominantly invested in stocks and always has been, And that makes good sense. Historically, stocks have been the best asset class, and I think currently it also looks like the best asset class. Properties have historically been good, but I think now are not as great. There are different factors with sort of the levels of construction in the best markets and the population growth rates not being as great as they used to. Bonds have historically been okay, but are currently not very good, I think. You are not receiving very high interest rates compared to the inflation rates for the bonds, compared to how much profits and growth companies have. Commodities have historically not done much, although they've been better in recent decades. Ultimately, if you have a barrel of oil, that just stays a barrel of oil, and if you wait a long time, you still just have a barrel of oil. A company is able to have profits every year and then reinvest that and grow and grow and grow and grow. So a small company can become a very big company, but a barrel of oil just stays a barrel of oil. Collectibles are very popular, but have not had very high returns, and I don't think will have that going forward. If you have invested in classical watches or Birkin bags or Pokemon cards or something at the right time, it will have been amazing. But there's also people who have invested in tulips or in stamp collections at the wrong time, and then that's sort of been quite terrible. And if you add those up, it's not a great overall asset category, although there are pockets of it that have been extremely excellent. Finally, currencies have historically been terrible. I think they're currently terrible and will continue to be terrible. They ultimately lose out as the money supply keeps increasing. If I have a lot of currency, I typically like to get that turned into some stocks instead. Now we can then look at the big factors that really drive economic growth in the long term for the world. So I like to split that out into the physical, the social, and the technological. So within the physical realm, I like to focus on nature, our natural endowments on Earth, how much oil and gas and different metals do we have in the ground in different places, how many trees do we have, and so forth. Then life, what are the demographics like in different places and how are they changing over time? The companies that have the right products for the right demographics in the right places, of course, have an advantage. Then the realm in which the most value can be created or destroyed the fastest is within the social realm. So if you have a bond or a stock or a deed to a property or a US dollar bill, these are all just pieces of paper, words in our heads and numbers on screens, that if we believe these, then they can help us cooperate with each other, and that cooperation can help us create a lot of value. But if we stop believing in these and stop cooperating, then a lot of value can quickly dissipate. Then why does anything really have value? It might be very obvious to you why a house has value. A house can be made of brick and mortar or made of concrete, and it's very, tangible, very sturdy. But ultimately, if humans don't want to live in houses and we don't want to look at houses and we all just want to go camping and hiking, then houses wouldn't have any value. And sometimes what we humans value changes over time. And if something's changing at a high pace, even if it's in a small part of society, but it's spreading, then that can be the basis for some great investments. Finally, there's the technological realm, all the way from the deepest pits of the R&D labs coming up with new scientific breakthroughs. Most importantly of those, the big technological revolutions that we've gone through. So going as humanity through the agricultural revolution, through the industrial revolution, to the internal combustion engine, to getting electricity, the computer, the internet, and now we are going through the AI technological revolution. But besides those big breakthroughs, there are also sort of the just day-by-day incremental innovation that's happening out in businesses and in people's homes. So people finding ways to just, do something they've been doing a little bit smarter. And if you have two companies and one of them are sort of just doing everything a little bit better every day and another where they're just slowly falling behind in everything, then, you might not notice that difference in the financial statements next quarter, but a few years later, it'll definitely show up. Then from those big factors driving the global economy in the long term, we can zoom in on how things are today. The overall picture today is quite positive. We have positive GDP growth across the major economies. We have quite low unemployment rates, although rising in some places. Interest rates are at a quite moderate level, giving central banks a lot of flexibility in which of their goals they wish to pursue the hardest and which ones they want to be a bit slower in pursuing. And inflation rates are generally close to being in target in most places. Not fully there everywhere, but sort of close enough that you can either try to get in goal slowly or maybe say, okay, we don't really need to get in goal too fast. But ultimately, we have a lot of firepower, both in treasuries and in central banks, to really help if there is any kind of crisis. So if there's some big negative surprise that could shock the economy, then we also have a lot to respond with in terms of monetary and fiscal resources to sort of just stop a crisis dead on. And that's a very nice and good, comfortable position to be in from an investment perspective. There was, during the COVID crisis, a period where I was very worried because we had exhausted all our monetary and fiscal capacity, basically. And if there had been another crisis, some big shock on top of the COVID shock, then we would have been in deep trouble. But thankfully, that's not where we are today. So I think that's some positive in the, yeah. Then there are some mega trends that I've identified as extra interesting. So if a company is driving or riding on the wave of one or more of these mega trends, then it's more likely to be found in my portfolio. So firstly, I like the nice to haves. When we humans, we have everything, then we like to compete with one another in who can have the better fashion and who can win in various fun games. And there are great companies with great profit margins and good growth opportunities in these industries, and companies within those found in my portfolio. But the nice to haves cannot really stand on their own, and neither in a portfolio nor in an economy or for the world. Because if you don't have the need to haves, then all those nice to haves, they fall away. If you don't have security, then you can't decide for yourself. If you don't have energy, well, then you can't have any of these ones. Then finally, there are the enablers and accelerators that help us do all these other things faster, better, or cheaper. And chief of these are the companies that I evaluate have a strong potential to have the highest profits from AI in the future, along with the companies that will be delivering us the next generation of amazing devices that we'll all be using in the future. Then, if you want to zoom in on a group of companies, a great way to get a quick overview of a group of companies is to use the multiples. So this is an example of the Magnificent Seven. So the 7 large tech companies in the US: Microsoft, Apple, Meta, Tesla, Nvidia, Alphabet, and Amazon. And here, if we look in the top left corner, we can see in terms of the profit margin that is looking very good for Microsoft at 47%, but absolutely incredibly good for Nvidia at 59%. Tesla is lagging quite a bit behind at 5% only. Then in terms of growth, again, Microsoft and generally across the board, we're having double-digit growth, which is really, nice. Nvidia is all the way up at 65%, but Tesla is actually declining. They're not growing anymore. That's not so good either. If you wanted to, have a big stake in Tesla, you would hope that they can have a higher profit margin, or get back to some growth again. In the two top charts here, the higher the better, because they're about profitability and growth. But in the two bottom charts, the lower the better, because they're ultimately about price. So in the bottom left, we can see that for every dollar of profit that Microsoft gets, as investors, we have to pay $21 to stake our claim on that. For Nvidia, we're paying $42 in enterprise value for every dollar of profit. And so that's a lot more expensive, but they're also growing a lot faster and are, having a higher profit margin. For Tesla, we are paying more than 100, more than 300 actually. I've kept the sort of chart at 100 here because ultimately it doesn't really matter. Like EV/EBIT is a very useful multiple if you are looking at companies within a certain level. If a company doesn't have any, like a biotech that has negative profits, it doesn't make much sense to really look at how negative this metric is. And similarly, if a company doesn't have much profit at all, then it doesn't really matter if this multiple is at 100 or 1,000 or 1 trillion or one, And so that just has to be said for fairness for Tesla here. I see many very retarded news articles posted on Reddit and on Twitter where people are like, wow, look at this company. They have a price earnings ratio of 1 trillion. It will take 1 trillion years for them to pay back, or they have to increase their profit by a factor 1 trillion. Sounds impossible. But ultimately, if you have two friends who are unemployed and one of them has a net worth of $2 and the other one has $1, like that's both very close to nothing. It doesn't make sense to say that the one who has $2 versus one is now, completely way more likely to, be very rich next year. Like the correct thing there is that once it's below a certain level, the sort of the level of additional meaning for every factor you multiply it by starts to go towards nothing. Then in the bottom right chart here, we have enterprise value to revenue. For Microsoft, we are paying $10 for every dollar of revenue they have. Quite fine given how much profitability they're getting out of every dollar of revenue and how fast they're growing it. For Nvidia, we are paying 24, but they are also growing it faster and they have more dollars of profit out of every dollar of revenue. For Amazon, we're only paying $3 for every dollar of revenue, but they're also getting a lot less profit out of every dollar and they're not growing it as fast. So it sort of makes good sense, I think, and you get a good overview when you look at companies in this way. Then the way that I generally work is that I have a lot of data that feeds into my financial models and help me make decisions. The data, a lot of it comes automatically in from my data providers, and some of it is my subjective numbers. So that could be something like, how much do I like the CEO on a scale from 1 to 10? That's subjective, but it's still a number, so I can use it to work together with the other numbers in my financial modeling. And here I value thousands of companies automatically, hundreds where I've set them up manually for each, and then I have 62 that I actually invest in. And then I value all those companies to see how good investments they are, rank from the best to the worst. Then I make a lot of risk scenario analysis where I evaluate how my portfolio would perform in different scenarios and how variance of it would perform in different scenarios. And then that helps me to think through, it looks like I could be doing poorly in these scenarios. I need to figure out some way I could be more safe here in a sort of in a smart way. And then those valuations and risk scenario financial models, they help me decide what research to make and what investments to make. So in terms of research, there'll often be something where I see, okay, this is looking interesting, but I need to learn more. I have to get more data. I have to maybe think of a different way of evaluating something. I have to learn about some new companies. I have to learn about the suppliers. So there's a lot of research I have to do. That research then helps me to change my input, helps me to change how I do financial modeling. And then that sort of goes around in a circle. And then with every company that I've researched, I've always learned something new. When I was analyzing Facebook at the beginning, I didn't just learn about Facebook and evaluate it. Oh my God, this is an amazing company with an amazing future. I also learned a lot about social media advertising. So when I was looking at other companies later, I would, go in and evaluate, what kind of advertising is this company doing? Are they doing social media advertising? They're only advertising on television. Sounds like they're not very smart. That gives some minus points for my evaluation of this company. And so every company has something unique and special about them. And you really learn what that is, then that also helps you to then better understand other companies. And then finally, I make my investment decisions. There are companies that I've already invested in, but I want to have even more. There are companies that I don't want to have anymore. I want to reduce my position. And the least attractive investments that I have are always at risk of being replaced by the most attractive investments that I have not yet gone into. So every day is basically day zero of me saying, what should I be invested in today? Hopefully that's what I already have. And if not, a change is needed. Then if we look at what is in my portfolio today. So we have 62 different assets spread across many different industries and geographies. The largest ones are Taiwan's semiconductor manufacturing company, Nvidia, Micron. So these are all companies that can do very well if we see a big AI boom. Then after these, I have Barrick, the gold miner, and Freeport, the copper miner. And you can always go on eToro's website or the eToro app and you can see exactly what I've invested in what percentages. And if we take my portfolio and compare with the US economy, we can see that in the US, it's not just one industry where there is all the economic activity. There's good activity across property, professional services, technology, manufacturing, health. My portfolio is more invested in tech, energy, semiconductors, metals and mining, and financial services. Then in terms of geography, my portfolio is slightly more invested in North America and Europe and slightly less in Asia and the rest of the world at the moment, although there are also good investments in those other categories. That was my presentation. Thank you very much for watching. And now I'll go through the questions that I've received. So firstly, how do you see the shift in US foreign policy and related topics of trade, security, and territorial disputes? So a lot of changes in US foreign policy I've been very sort of hurt by as a European, but I also understand where it's coming from, both in terms of sort of general strategic priorities of the US, and then the ones that are more specific to the Trump administration. And those ones, I think the best way to understand them is there's a book written by the Secretary of War, Pete Hegseth, called American Crusade, which sort of lays out the challenges for Christianity and capitalism in who are the enemies of his ideology. And it's really, the Chinese communists, the European social democrats, and the Democrats in the US that are really the enemies for, So if America is to some extent subsidizing Europe militarily, it sort of makes American capitalism look worse while it's making European socialism look better. And that's sort of not ideal from this ideological perspective. And then if America has to focus on its own hemisphere and on China, there's just less room to really help Europe. And especially if you then go in and say, from Pete Hegseth and Donald Trump and others' perspective, that actually in terms of promoting Christianity and capitalism, maybe actually Russia is closer to our position than Europe is. So that sort of puts them in a position where at least they're slowly getting away from the more traditional, strong alliance of Europe and America, and where we should still have a lot of shared interests there on some areas where we potentially maybe disagree for a while. Although I think Europe is also showing some changes. So in the way that maybe America has done some negative things, the silver lining maybe is that it's finally forced Europe to start doing a little bit better. Are you worried about the US annexing Greenland? How would you react? So I've been worrying about that for a long time, and every time I've mentioned it, people have sort of thought I was crazy, and then at some point people didn't think it was so crazy anymore. It's not the base case or a very likely scenario, but I like working my way through scenarios, and so this is a great scenario to sort of think through exactly what should you buy or sell depending on how this plays out, and in the most extreme scenarios, exactly how should I adjust my setup. And ultimately, to answer the second part of the question here, I would always follow the guidance of the Danish Ministry of Foreign Affairs. So if they were to say, Jeppe, you have to go to Greenland and die for your country, then okay, fine, then I'll do that. But yeah, I don't expect that that's gone, but I plan for a lot of scenarios that I don't think are the most likely. And by the way, I mean, the great reason for doing that is that, sometimes, for instance, I went through a large exercise of planning what I would do with very high energy prices based off of some scenarios that would cause that. But then in the end, if we have very high energy prices for another reason, some of that analysis is still useful. So sort of, if you then think about, okay, maybe you make a long analysis of what will happen if the US annexes Greenland, and then that's not what happened. Instead, they annex Canada or something else happens, then a lot of that stuff, that you had thought through will actually still be extremely relevant. What will the rupture between US and Europe do to stocks? So I think the first gut reaction many people have is we need to sell some of our US assets and buy European instead because of the dumb stuff that America is doing. And that's only a partial analysis, because you're forgetting what Europe is doing that's also dumb. So if America was only doing stupid things and Europe was doing everything right, a lot of capital would flow to Europe. But because Europe is also doing a lot of things wrong, and I'm not talking about Europe is often good at saying the right thing, but we are much, much worse at actually doing the right things. As a sort of funny example, you can always go the European Investment Bank, if you follow their Twitter, they always write what they've invested in, but they never write about whether that was actually a successful investment and it did any good. And so we are sort of good at announcing that we are going to do something, but the results are just not always following. So I think there's Mohammed El-Arian, a good economist. He often says that America is the least dirty shirt. He's saying like America does a lot of bad things, and their saving grace is that others do even dumber things. What will happen in April 2026? Will the stock market crash of April 2025 repeat itself? The current technical charts seem to show signs of overlapping with last year's situation. So for the last part, technical analysis is complete garbage. It's useless. It's the investment's equivalent of astrology. You wouldn't use astrology to go to Mars. You would use astronomy. And you wouldn't say, let's mix astrology with astronomy. Using both? No, use neither. You should never use any technical analysis. And whenever anybody mentions technical analysis, I say that they're using it, you should run away screaming. It's really really you should use what you would be taught in a good investment class at a good university, and not this But then in terms of, will the stock market crash of April 2025 repeat itself? So in April 2025 there was the big announcement of tariffs from the US, and that caused the S&P 500 amongst other factors to drop by 12%. But before April was even over, it had fully recovered. So it was sort of like the month of April wasn't itself overall a crash. It was just like a decline and back up again. And then with that happen, well, maybe Trump is planning to announce a big set of tariffs at the start of April, as a maybe 1 year anniversary. In that case, it would probably be a smaller repeat, because people, remembering that it went down up again, might not sell off as hard at that time. But ultimately, I don't think this is a very sort of useful way to say, like, look at how the chart developed last year and then think that, oh, this will repeat itself. It's that's just not really how the stock market is an auction system. We get to buy and sell things based off of what we think they will be worth in the future, and that's not really tied to what it was worth in the past. Is it possible to have a corporate account on eToro? So that's a simple, straightforward yes. You can have a corporate account on eToro, depending on which country you reside in. The minimum account size is, I think, 10,000, 25,000, or 50,000 US dollars. And there is, of course, a procedure to submit the corporate documents and whatnot. But then you can have a corporate account. Your company can have an account. What is your outlook for quantum technology over 3 to 5 years? So in quantum technology, we have had some very nice breakthroughs over the past decade. We have one company in the portfolio, Google, which has done interesting research in the scientific field. But overall, there's two big problems with quantum technology, specifically with towards getting quantum computing. One is that the technology is not there at all. So it will have many cool breakthroughs, but we need like a lot of breakthroughs before we have anything that's really useful. But then actually the sort of workload that we could really efficiently solve with a good quantum computer isn't that big either. So most of the data processing we do wouldn't be handled much better with a quantum computer. So then we have very few qubits effectively to actually calculate anything with. So it's sort of like we don't have this as a solution yet, and even if we did, we didn't have that many problems to solve with it. And so we're probably on a much further time horizon for this being very relevant, and so I don't think it's very exciting. And a lot of the companies that are really only focused on this, I reviewed them, and I think they're very uninteresting from an investment perspective. I think they'll just continue losing money, and maybe they'll do some good science that will be some of those breakthroughs that in total one day will lead to something cool. But ultimately, I think it's a way of throwing out money, and yeah, I think there's a little bit of a tendency for some people who missed AI in a way, then instead of accepting that this is the big thing happening and actually investing in AI, they're instead looking for what could be the next new thing, because I missed the last new thing, and then I missed the new thing, and so let me jump onto the next thing. But then by jumping onto the next thing, they are missing the big AI revolution now, and that's just not so good. Please discuss PayPal, Adobe, Salesforce, and other value plays, value traps. I think that's a good value trap statement, because a lot of these companies, I think they have some strong moats now that make it difficult for competitors to properly compete with them, and therefore they can have some good profit margins, but these are not sustainable competitive advantages. They will be eroded very severely over a few years, and then they won't be able to have very high profit margins. And so this kind of companies I really don't like, and you will probably not find them in my portfolio. How should we react to Japan's interest rate change? So in general, certainly it's not something that I have to react to, and for most investors, it's not something you have to react to. If you are willing to, not make much money from your capital, you say, I don't want to make a lot of money. I just want to have a bad return. Then you can worry a lot about this, because there's a strategy that many large institutional investors have been doing, where they've been borrowing, Japanese yen, and then lending in different currencies, and in a time when the Japanese interest rate has been very low and others have been a bit higher, they could pocket the difference, although it's not much, but it's something. Now that investment strategy that was already not very interesting is now even less interesting as Japan's interest rate has increased. It's not very high still, but higher than it was, so that spread has shortened. So you had something that was uninteresting, and now it's even less interesting. So I don't think that's very exciting at all. And so the only thing there would be some kind of need to react is, say that a large financial institution had become way overexposed, breaking all sensible risk management practices and become way overexposed in this, and they would suddenly be going bankrupt, and then that would be, that would be different. But I don't think that that's really the case. I think this has sort of happened very gradually. So yeah, I don't think that's a worry at all. Have you considered adding gold to your portfolio, and what is your outlook for gold? So I really like gold, and I already have a lot of gold in the portfolio in the form of gold mining stocks. I've had them for a long time, and they've done very well for me, including last year here. And I think, maybe the best way to have gold is as jewelry on your wife, but the second best, in my view, is the gold mining stocks. If the gold price was only going to be high for a short while, right, then it would be good to just have gold and sell the gold, and then be out of it. But if you evaluate that gold has a good likelihood of being priced very highly for many, many years to come, then the gold mines, which are quite cheap and are able to keep mining more gold, they have great concessions, great reserves of gold that they can keep mining, they can actually come out with a lot of gold. And now in the short term, they generally agree prices. So those prices, are not as high as the ones you would be seeing in the market. But then as time goes by and those contracts expire and new ones replace them, they are closer to the current market price, and then you'll see the profits really skyrocket. And that's so I think gold mining stocks, very happy to have them in the portfolio, and I have a great I think they can do very well. Opinion on Constellation Energy Corp. So this is, I think, a great company, really a strong player in American nuclear power, and I think they have a great future ahead. And there are some different sort of challenges towards expanding the energy output and being able to get the fair price for this. And those challenges have to sort of be met from the whole industry. But yeah, I think it's overall looking very good. Is the best AI opportunity shifting from the software layer to the infrastructure or commodities layer? So I think the short answer is yes. I think the opportunity was initially expected to be more in the software layer, and it has gradually shown itself to be more likely to be in the infrastructure and commodities layers. But within each value chain stage, there are some companies that I think can have extraordinary levels of profits. So those are great to have. And they also put you in a more diversified position. So as potentially, where we think the bottlenecks will be changes. So, now we think we'll be running out of RAM, but no, we run out of energy before we run out of that. Then, then you can sort of, you can probably catch that at the right time, but also with a little bit of diversification across the value chain, you will win out on the whole opportunity. Even if some parts of the value chain, they end up showing that they were way too competitive and end up with way too low profit margins. Is there an AI bubble? So I think the short answer is no, but there are probably some, there are many companies that are doing something with AI that are losing a lot of money, and I don't think they'll ever make money. So I wouldn't want to be investing in those. And there are many companies that I think that are doing something, and they are, not worth their price at all, because they'll be damaged a lot by AI. Some will suddenly find that, that the big piece of software they had built that they thought was so unique and special is being outcompeted because now it's so easy to create new software. But ultimately, I think the trajectory we've been seeing with AI getting better and better and better will continue. And as it gets better and better and better, it gets to different, it's sort of, if I tell you can have a 15-year-old assistant, it's very limited what he can actually help you with and how much value he can create. And that's how you can have a 17-year-old smart kid. You're like, a little bit better. But once it's like, now you can have, a supremely good 35-year-old analyst that's an expert in this level of assistant. Now there's just so much you can do with this. So it's sort of, there was also this, if you look at the development of the efficiency of engines over time, and then the value and the market of horses, you could sort of see that the engine slowly and steadily got better, but it didn't have a big impact on horses until suddenly an engine was more efficient than a horse. Boom! Then the horse market collapsed. And in that way, I think AI gets better and better and better and better. And once it reaches a certain threshold, then suddenly it sort of skyrockets. And so I think that's I don't think it's an AI bubble. I think it's more likely the opposite, that it's an actual major technological revolution that we'll be going through, and that, you know, in the same way that maybe people before the internet or at the very start of the internet would have thought, is this a fad? Will people be using this in the future? Oh, I don't know. I will, you know, sell all of my Amazon stocks in the year 2001 because I don't believe in the internet anymore. And then, you know, it turns out in retrospect, actually, you should have kept those Amazon stocks because in the end, the internet wasn't a bubble. And I think also, you know, it will turn out that AI actually becomes very good in the long term. Will AI cause unemployment? Mostly no. Different countries will be a little bit differently impacted based off of how flexible their employment markets are. So in ones where there requires a lot of sort of union-based major negotiations, and where there are high minimum salaries, minimum wages, and so forth, where there's a lot of regulation in place, you know, that can work in both ways. That can sort of cause it to not be so easy to fire a lot of people quickly. On the other hand, once people get fired, it can be hard to get them reemployed. But overall, tools don't cause unemployment. If you imagine that we wanted to create a lot of jobs today, and we said, okay, let's create the maximum amount of jobs. We'll outlaw every single tool. Nobody can use a computer. Nobody can read a book. Nobody can have a hammer. Nobody can have any tools. We all use our hands. Then we would create a lot of poverty. We would create a lot of starvation. We would not have any new buildings. We would fail to repair a lot of stuff. So we'd be very busy doing all of that. So you'd say, okay, we created, you know, but you know, there wouldn't even be more jobs. There would just be a lot less efficiency. So it's a lot of, you can have better tools and then able to just produce more so we can all consume more. They don't necessarily cause us to be, oh, now we have enough. Now we don't want anything more. And as an extreme example, imagine that tomorrow one of my companies manages to lay off a lot of employees because of they managed to implement AI in a certain way. Now those people are unemployed immediately. But then you say, but what are then the new jobs that will be created so that they can, you know, move from that and ideally into better jobs? Well, that depends. So who now is, because, you know, my company here, they're no longer paying these employees, so they're much more profitable. So their share prices up. They're giving out a big dividend. So all their investors, maybe the remaining employees that have their bonuses, they're a lot richer. So what will they do with this money? Well, if they don't do anything with it, well, then the money sort of like is pointless, right? People will do something with it. So for instance, I might say, actually, you know, there are some different restaurants down here. I'm going to go to the one that has a piano player because I prefer a piano player over a restaurant that just has a stereo playing music, you know, even though it might sound the same. I prefer the human piano player. So then I go to that restaurant. So now there's work for an extra piano player. That piano player who was maybe part-time is now full-time. And so you just have to look, what would the people that are then saving money then want instead? And that's where all the other new jobs will come from. And, you know, when something becomes much more efficient, we also end up using it a lot more. So that's sort of, the core of why AI will not really cause mass unemployment. How will companies profit if the customers are all out of jobs? That's a very extreme case where robots, AI can really just start doing everything. And in such a case, I think for people, the government will provide something like a universal high income, because imagine that I have a factory that can just produce more than enough goods and services for myself and everybody. Then, you know, you don't have to tax me many percent. Just a few percent of my money is enough to give everybody everything they want, and I can keep the rest. So that point, it becomes very easy just with current like charity percentages to take care of everybody. And companies will, of course, have to produce the products and services that people want. So if you have a situation where we have extreme inequality, many people are very poor, well, then companies will have to produce some very cheap products, maybe for those people that are very poor. And then, you know, if there are few people that are very rich, well, companies will have to produce some products that those very rich people will want. So it could be that if there's a hollowing out of the middle class, companies have to adjust. But I wouldn't worry about companies not being able to make profits just because a lot of customers out there out of jobs. Companies, they can, you know, just make products for the people that have the money. What are your thoughts on Ripple? So Ripple was one of the early cryptos to sort of not be all against the system, but instead say, you know, we actually, you know, try to have a bit of a conservative aesthetic, and, you know, we want to be seen as the one that kind of wants to integrate with the system and, you know, collaborate with the banks and so forth. And so many followed suit after that, and so they deserve a lot of credit for being, if not the first, one of the first to sort of really push in that direction. But other than that, I don't think, I'm not a big fan of blockchain, and I don't really, see myself holding Ripple. How exposed are we to the potential decline of the US dollar? So we're not really exposed to that. In general, the having a strong US dollar as the reserve currency is good for the US, good for US banks, and it's good for the world as well. The US dollar, if you look at futures prices, is expected to decline a little bit more than other major currencies. And so that's already built in. But if we saw, for instance, a decline significantly worse than that, then what would really happen? Well, companies in our portfolio can generally just increase their prices. So if they were expecting to charge $100, they can just charge $120. So they offset it a lot like that. Some are on more long-term contracts, so for them it sucks a little bit more, but that's not sort of that big a part of their company valuations. But on the flip side, many companies in the portfolio have debt denominated in US dollars. So they owe dollars. So if the US dollar loses a lot of value, well, then actually the real cost of servicing that debt is now a lot lower. So actually they gain a lot from a decline of the US dollar. So when they factor those together, we're actually quite all right, no matter what happens to the US dollar. And then if the US dollar declines severely, then maybe you'll see that your stocks are worth a lot more dollars. And you're like, oh, they're worth a lot more dollars. Yes, but if the dollar's worth a lot less, what is your actual return? So there it could make sense for some people, to go on eToro, click settings, and then you want to see the return in euros instead. Because then, you might see the returns reflected in the currency that's more relevant to you. Ultimately, you can calculate your returns in 2020 US dollars or in euros or in tomatoes or in gold or basket of goods or in any other way. This is like whether you're using miles per hour or kilometers per hour or knots to measure the speed of your boat. Like, it's not actually important which one you use, but you have to be aware which one you're using so you don't think like, oh, it's looking like I'm going fast. Yeah, but that's because you're going in kilometers per hour but actually this number is in miles per hour. So you just have to know which one you're using to look at your return. What do you expect with Kevin Walsh as the new chairman of the Federal Reserve? So I think he sounds very sensible. Some of the economists that I they like him as a pick. I think he's going to be similar to Jerome Powell. He will talk different but act similarly. I don't think he's going to be as dovish as Trump would want, and he's not going to be as hawkish as sort of I guess some traditionalists would want. He talks about reforming the Fed in different ways, but I'm not sure how much of a reform there will actually be. And so I think it's a good pick, and I think we can feel somewhat safe here. I don't think he's going to collapse the dollar or really save it either. I think you can sort of to some extent evaluate candidates by what you expect their inflation rate would be across different scenarios. And I think his I don't think he's very, very keen on immediately getting the inflation rate down to the target of 2%. I think he's okay with, letting it ride a little higher for a little longer. How and when do you anticipate a market crash? So, if you had invested in the SP 500 all the way back at the start of the last century, you would have made a lot of money. You would have made on average every year 7% real return, on average doubling your portfolio every decade. That's really amazing. And when you look at it zoomed out, it's like just one line up. Very amazing. But when you zoom in, you'll see like, oh, actually, it doubled here, and then it was cut in half here, and then it was doubled here, and then it cut in half here, up by 20%, down by 30%, up by 40%, and so forth. But when you average all that out, you're left with a good return. And so there's an important aspect of being a long-term investor in being able to accept that each month is different and that each year is different, and you are okay that you invest now and then next year is terrible, because you can afford for there to be good and bad years as long as over the next 30 years you're overall good. And overall, if you put your money in cash, maybe you won't lose everything next year, and maybe you won't lose half next year, but over 30 years you will lose a lot. And on the other hand, if you're on stocks, you might lose a lot next year, but then you might gain it the year after. And if you wait a long time, you should probably be okay. If you had invested right before the great financial crisis, you would have immediately lost 56%. But today, your portfolio would still have more than tripled in value. So even if you sort of invested at the worst time, you would still have been very okay. And a lot of people they actually lose out a lot because they keep expecting a crash. If the market has gone up recently, they think, oh, the market's gone up, I'm worried, maybe it's at the top now, I don't want to invest. Then the market goes down, oh, now it's going down, what if it keeps going down, oh, I'm worried, I don't want to invest. So the reason for why they're worried, that constantly changes from, oh, Greek sovereign debt crisis, oh, what about COVID, oh no, what about Trump getting elected, what about Brexit? There's always some new thing that they're super worried about, and then year after year after year, they just lose out, and when there is finally a crash, they'll be like, look, I told there was going to be a crash, I'm finally right. But then if you actually look at their total returns, they're just very terrible. So you're better off accepting that there's going to be a crash at some point, you don't know when, and you just say, that's okay with me, because I like, the die roll. And if I have a good die roll and I keep rolling it, in the end, it doesn't matter what each individual die came out as. What matters is the total average. So there's a good quote by the former CEO of Goldman Sachs. He said that, I don't know when the next crash will come, and I also know that nobody else knows. And so that was sort of his key insight there. And ultimately, if you talk to all the economists in the world and you analyzed all the data and you did everything you really possibly could to identify when the next market crash would be, you wouldn't know. And if you didn't do anything, you also wouldn't know. So you sort of, when picking between those two options, there's just only one that's the sensible one. What is your stance on Microsoft? Will Windows be outcompeted in the operating system market? I think overall Microsoft is really strong. They have different business units, some of them that are being really managed well and others that are being managed very poorly. So Microsoft contains these extremes. And Windows is unfortunately one of the products that's being managed very poorly. It's really a big tragedy in a sense. But they're also sort of difficult to get out of. They have a strong moat. So will they be outcompeted? Some will switch over to MacBooks. Maybe Huawei operating system will take something. Some will switch over to Linux instead of the current environment. Then you got, when we get the next generation of devices, say we all switch to using virtual reality or smart glasses or headphones only or like a smart contact lenses, Neuralink devices. For any kind of new generation of devices we'd all be using, there could be a new winner in that operating system market. So Microsoft did not manage to, win in the mobile operating system market. Android and Apple did. So that was, quite unfortunate. And so, potentially that would happen again. And then Windows itself, of course, could be attacked from these fronts. Also, just if we keep using more AI and one AI tool becomes really dominant, then potentially it would be easy to sort of switch between different operating systems and ultimately maybe build an operating system underneath that thing that everybody's using. Sort of that platform shift. So these are some of the risks there. And yeah, they're in a good position, Microsoft. They could do a lot more with Windows. I don't think the base case is that they'll lose the operating system market, but yeah, they shouldn't be complacent. Is now a good time to add more funds, start copying? So currently, I have to decide how I want my money to be invested, and so I invest my money in the way I think is the best. And then if you copy me, then you are at any given time invested in the same way as me, in the way that I think is the best way to be invested. If I thought, oh, now is a terrible time to have stocks, I wouldn't have stocks and then tell everybody to not copy me. I would just not have stocks. I would just, if I thought now, is the time to only have European stocks, then I would just have European stocks only. So at any given time, I cannot really advise people based off, because people are in many different individual situations. Some have a lot of debt with a high interest rate. They should be paying that off first. Some maybe, they know they'll be staying in the same place for a long time. And this is a place where rents are very high compared to buying a property. So they should be buying a property. But ultimately, many people have a lot of cash earning a low interest rate, which would be better placed in stocks. And so for any such amounts, it makes very good sense to start copying with that or adding that in. But there can be other good ways to deploy one's capital as well. Do you see the memory chip sector as a good opportunity for long-term investment? Yes, I think this is an absolutely incredible sector. I think the outlook for profitability and growth here is absolutely astronomical. And yeah, that's why you see Micron as one of my largest positions. So I think this is a very good sector. So thank you very much, everybody, for watching, and thank you very much to everybody who has submitted questions. Let's have a great quarter.